What if I told you there's a financial tool that lets you control a $50,000 stock position for less than $1,000? A tool that can give you a 1,000% return in a single day, but whose complexities have humbled even the world's most brilliant financial minds. Welcome to the world of options, the undisputed masters of leverage and strategy in the financial universe. Today, we're demystifying these powerful contracts. We'll uncover what they really are, explore the critical difference between calls and puts, and reveal how a horde of retail traders used options to launch the most legendary short squeeze in history. By the end of this video, you'll understand the core mechanics of options, why they're used for everything from simple bets to billion-dollar hedges, and how they offer a level of strategic flexibility that no other financial instrument can match. Let's start with the basics. An options contract is simply the right, but not the obligation, to buy or sell an asset at a predetermined price on or before a future date. Think of it like putting a deposit down on a house. Imagine you find a house for $500,000 that you think will be worth $600,000 in 3 months. You pay the owner a $5,000 non-refundable fee to have the exclusive option to buy that house for $500,000 anytime in the next 3 months. If the house price skyrockets to $600,000, you exercise your option, buy it for $500,000 and instantly make a profit. If the price crashes to $400,000, you let the option expire. You don't buy the house. Your only loss is the $5,000 fee you paid. You had limited risk. That's an option. The fee is the premium. The $500,000 price is the strike price. And the 3-month window is the expiration date. The two flavors, calls and puts. Options come in two simple flavors. A call option gives you the right to buy. You buy calls when you think the price will go up. A put option gives you the right to sell. You buy puts when you think the price will go down. Let me show you the explosive power of options with a story you've definitely heard of. In early 2021, hedge funds were massively short-selling GameStop stock, betting it would go to zero. But on the subreddit WallStreetBets, an army of retail traders saw an opportunity. They didn't just buy the stock, they bought huge numbers of cheap, out-of-the-money call options. Why? Because it gave them insane leverage. For a few $100s, they could control thousands of dollars worth of stock. Here's where it gets wild. When you buy a call option, someone has to sell it to you, usually a big market maker. To hedge their own risk, these market makers have to buy the actual shares of GameStop. As thousands of retail traders bought more and more call options, the market makers were forced to buy more and more shares. This created a feedback loop from hell called a gamma squeeze. The options buying forced stock buying, which drove the stock price higher, which made the options even more valuable, forcing even more stock buying. GameStop stock exploded from under $20 to over $480. The retail army, using options as their primary weapon, inflicted over $20 billion in losses on the hedge funds. It was a masterclass in how options can turn the tables and create market chaos. The most common type, which we've been talking about, are options on individual stocks like Apple, AAPL, or Tesla, TSLA. These let you speculate on the performance of a single company. Next up are index options, which track major market indexes like the S&P 500, SPX, or the NASDAQ 100, NDX. Instead of betting on one company, you can bet on the direction of the entire market. These are massive, with trillions of dollars in value traded, and are used by big institutions to hedge their portfolios. And yes, you can even buy options on futures contracts. An option on crude oil futures, for example, gives a farmer or an airline the right, but not the obligation, to enter into a futures contract. It's a way of hedging their hedge. Just like in the GameStop saga, options offer incredible leverage. You can control 100 shares of a stock for a fraction of the cost of buying them outright, magnifying your potential gains. This is the most beautiful part of buying an option. Your maximum loss is always limited to the premium you paid for the contract. If you're wrong, you only lose what you paid. If you're right, your profit potential is theoretically unlimited. Options aren't just for simple up or down bets. You can construct strategies to profit if a stock stays flat, if volatility increases, or even just from the passage of time. This is why options are often called the chess of the financial world. Let me tell you about a legendary anonymous options trader nicknamed 50 Cent. For years, this trader consistently made the same bet. They would spend millions of dollars buying VIX call options for about 50 cents apiece. The VIX is the market's fear index. It measures expected volatility. By buying VIX calls, 50 Cent was making a constant massive bet that a market crash was just around the corner. For months, sometimes years, these options would expire worthless and the trader would lose millions. The market called them crazy, but they kept at it, buying these cheap lottery ticket-like options day after day. Then, when the market did panic, like during the 2018 Volmageddon or the COVID crash of 2020, the VIX would explode. Those 50 cent options would suddenly be worth $10, $20, or even more. The mysterious trader reportedly made hundreds of millions of dollars in profit, proving that options are one of the most powerful ways to hedge against or profit from total market chaos. Options are financial multi-tools. They can be used for leverage, for defining risk, for hedging, or for complex strategies that can topple even the biggest hedge funds. Their combination of limited risk and unlimited reward potential makes them uniquely powerful. But this is just scratching the surface. The power of options also has a dark side, a history filled with catastrophic losses, strategies that have blown up entire firms, and market events that defied all logic. If you want to see how selling options bankrupted Nobel Prize winners and how a single trader's bad hedge cost JP Morgan over $6 billion, make sure to subscribe and hit that notification bell. Trust me, the stories we'll explore next will show you just how dangerous these financial weapons can be.